Hello traders, the title of the video is how to begin bulls and bears Elliott wave principle trading like a pro. Are you a bearish trader? Are you a die-hard bearish trader? Are you a bullish trader? Are you a stubborn bullish trader? In this tutorial, I want to share with you how one can begin bulls and bear, Elliott wave principle trading like a pro. So talking about the bulls and bears Elliott wave principle trading like a pro, you want to know when you should become bearish and when you should become bullish. You are a bearish trader, but you want to know also when you should become a bullish trader. You are a bullish trader, and you want to know also when you should become a bearish trader. All right. It's completely mad to be just a bullish trader because the market does not go up forever. On the other hand, it's also crazy to be a permanent bearish trader looking to sell for no reasons. The natural progression of the market is up, so if you are just a crazy bearish trader, it's not also helpful to you. So we will use the Elliott wave principle to time the market to know when we should become a bullish and when we should become a bearish. All right. So what should we look for? We look for signs, S-I-G-N, signs. All right. One of the signs that we look for is the surge in trading volume. All right. When we have a surge in trading volume, it usually slows down the price. I talk about it at 24 Stock Trader YouTube channel, a channel that I promised trader that I will make it amazing YouTube channel. For sure. All right. So we look for surge in trading volume. That's the first sign that we look for. All right. We look also for patterns. We look for pattern. One of the patterns that I want to share with you today, which I talked about once before, allow me to mention to traders again, is on the yearly chart. So if you can't see the yearly chart with your trading software, then it's not going to be good for you. In that case, you have to use TC2000. All right. I have no connection with TC2000. I'm just a user like anybody else using TC2000. On the yearly chart, you see, when you are on the yearly chart counting wave, you see, we may say on this chart, it's clear, first wave of a higher degree, all right? Second wave of a higher degree, all right? And then we call this one a third wave of a higher degree. I'm going to color it now into orange, okay? Let's color it dark green. It will be clearer, you see? That's a green on my chart. So the third wave of a higher degree. What usually happens when you are counting wave on a yearly chart like this, very often you see that you call this a third wave is a mistake. The third wave has end somewhere here. How do I know? Because of the experience. You usually see, if you see the third wave on the yearly chart like this with a shadow and the tail all this like this, you know that the third wave has finished before that. Just the experience of using a yearly chart by looking at it like this, or I won't fall into the previous trap, which means I'll label it like this third wave. I'll put it here instead. So those are few signs that we look for: the surge in trading volume and also the candlestick pattern, especially on the yearly chart with a shadow like this. Even on the 4-hour time frame daily chart, you see sometimes the trader will call this a third Elliott wave, but it's not the end of the third Elliott wave, because it's rare that you see a third wave with all kind of shadow like this ending like this. Rare, very rare. If you see that, especially on the yearly chart like this, think of a flat correction. So our third Elliott wave probably has ended here, and alerting me that okay, George, the bear are coming into the market. So if you see on the yearly chart like this, you see we're calling something third wave with a shadow like this, which we probably went up all the way, bullish candle, people sold it down. It means that the bears are coming into the market. You see this one here, probably this is the fourth wave here, followed by the fifth wave ending somewhere here. You may see a fifth wave with a shadow on top of it like this, but the third wave is rarely that you may see it with a shadow on top of it, especially, very important, the yearly chart. All right. So when a correction has begun, all right, especially a corrective wave of a higher degree is starting, we also see a surge in trading volume. So it's not very, very good right now, but it's happening a bit now. See some volume start popping up a bit here. But normally, those are signs that we look for. At the beginning of a bullish trend, we usually see a surge in trading volume, alerting us, okay, George, it's time to roll the sleeves and become a bullish trader. So you see here, so the average volume here, all right, was 187 million shares. Now it ran fast. We see a first surge, bringing it to 515 million shares. Something is going on, and the stock traders understand it. Something is going on. Why people take too much interest in this tractor supply corporation stock? That's the first sign. Now the second surge into the volume came, bringing it to 659 million shares, added to the 500 million shares that we already have. What's going on? More than 1 billion shares within 2 years after this horizontal move. Now, talking about bulls and bears. Okay? Area wave principle trading, like a pro. We see a consolidation now, price start breaking resistance with a surge in trading volume. It's time to think like a bullish trader. Normally, during the consolidation phase, that's why we see the surge in trading volume. Sometimes the smart money will keep quiet, so they are loading it gently, 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 gently. They say, don't reveal to them we are buying and hold. Now, as the first wave, which is the signature of the bull in an uptrend, is in place, they're revealing their full sprint, surge into the volume. People wondering what's going on. Don't sell if you see a bearish divergence at the end of the first bullish move. Don't sell it. If you see a surge into the volume in the first wave, and you see a bearish divergence at the end of that first wave, let other crazy traders sell it down so you may buy at the end of that second wave. This is what's happening here. At the end of the second wave of a higher degree, look again. This is another sign here. After a pullback under a normal volume, look at this one. A gigantic surge in trading volume. This one. Talking about this tall one here. How many? 778 million shares after a pullback to retest the moving at 14. So there was a consolidation, there was a breakout with a surge in trade volume, price pullback to moving at 14. Here it is. The second sign to become bullish. Don't be bearish. All right? Price breaking resistance, forming a higher low. Don't be bearish. Be bullish. Even if you are, okay, a stubborn, crazy, bearish trader looking to sell for no reason. You are looking for every excuse to sell. There are traders out there like that, all right? So don't sell at all. And the moving at 14 is rising, price bouncing, pull back to retest a rising moving at 14, surge in trading volume, be bullish straight up, even if you are using the area wave. So first wave, second wave, with the wave principle, is surge in trading volume, another sign to be bullish trader. Now if the price breaks above the high of the first wave, you will apply Fibonacci extension to the first wave. You will highlight the 161.8% Fibonacci extension level. If it breaks above the 161.8% Fibonacci extension level of the first wave and find support, it's time to be what? A bullish trader. Don't sell. If it breaks and finds support above the 161.8%, which it did here, that's the 161.8%. If I move that red line there at 161.8% Fibonacci extension level of that first wave, that's there. After you find support above it, don't try to be a bearish trader. All right? You see here, there were a little bit, you see, they push it again, people bought it again here. All right? How many? 425 million shares. So after the retest of the moving at 14, same region they bought it, in the zone 455. After we cross the 161.8% again, another 400 million shares being transacted. So those are signals that we are looking for. So you want to check what they are doing. The smart money is buying. So this one is a huge one. That's at the end of the second wave. First sign to be bullish. All right. It breaks the 161.8% level. All right. So first level you want to watch, even watch this one. Look at this one. Look at this volume bar here. Another 400 million share after it was crossing the 138.2% Fibonacci extension level. Can you see the small tail of this one on the yearly chart? It was retesting the 138.2% critical Fibonacci extension level of the first wave. And after it breaks above the 161.8% level, another 400 million share being transacted. Look careful. As it hits the zone of 314% Fibonacci extension level of the first wave, where very often the third wave will end, not always, no guarantee, but very often, there were sellers there. So when you buy, my friend, you are catching the third area wave, and the third wave reaches the 314% Fibonacci extension level of the first wave, it's time to take some profit. That's what the professional did here. So you will be mildly bearish. Don't be completely bearish. Be mildly bearish. Reasonable bearish, which means take some profit if you are a bullish trader. Don't be completely a bearish trader, but just take profit. Be bearish, just taking profit, because the trend is not finished yet. But some third area wave will end there, but this one did not. Look at this bullish candle bar crossing it. Okay, that's why I say to you, probably our fourth area wave is this one here. You see the tail of this candle bar, that's the fourth wave of the higher degree. That's it, that's the fourth wave of a higher degree, right there. So, as I was telling you on the yearly chart with my experience, those shadows are alerting me that probably at the end of the fifth wave we have a flat correction here. Those are signs that we use to alert us that it's time to be bearish. So now we see this is the fifth wave of the higher degree. So just on the yearly chart, I can see them. You'll see soon. So first wave, second wave, third wave, fourth wave. But that's the tail here. You'll see on many charts. So look carefully on the yearly chart what we have seen here, and go to other yearly charts, and you'll see similar scenario for some stock. And then break it down to the monthly chart. Try to validate that wave count, and you will see that everything will work well. Okay, if you handle it carefully, it should work well. Now, this is telling us it's time to be fully fledged bearish trader. Why? Why? Because a higher degree multi-way has ended, a proper correction will begin. 1, 2, 3, 4, 5 on a higher degree, we'll expect a proper correction. Which level should we watch? We'll watch the 50% and the 61.8% Fibonacci retracement level of the whole trend. Well, so have I said to trader when I was recording that video about how to become an intelligent area wave trader? In part 3, I was telling trader that one cannot call oneself a serious or a competent or efficient or capable area wave trader if one does not master the the Fibonacci extension, the Fibonacci retracement, and the predictive fractal pattern. So watch that video, part 3, how to become an intelligent area wave trader. So now, as the correction has begun here, we see this. Usually you can see a shadow on top of the fifth wave, and also during the corrective phase. Those are normal, especially on the yearly chart. I keep saying the yearly chart so you don't go and do it on another time frame. All right, so allow me to say that many times. So it's time to be a bearish trader. Now we count 1, 2, 3, 4, 5 way. No, on the monthly chart, no, on the daily chart. If you want the monthly chart, we have to go to the higher degree wave count to validate whether that multi-way that is ending on the monthly chart is it corresponding also to the end of a higher degree multi-way. If not, we know that the higher degree wave cycle is not finished yet, or multi-way is not finished yet. So there are more to come. So though we may expect a correction on a daily chart or weekly chart or monthly chart, if the higher degree multi-way is not finished, that correction is only a corrective wave or an internal corrective wave of a higher degree corrective wave. Are you confused? Don't be confused. It's Elliott wave. All right. So we are here now. So now it's time to be bearish trader. So you'll be wearing your red jacket as a bearish trader. All right, selling like mad. So this is the time that the bearish trader will be jumping all over the place, shouting at the market, blah, blah, blah. So this stock is in a corrective phase now, talking about a higher degree wave count. This is a bigger correction. So which level are we watching? Okay, we talk about Elliott wave, we talk about Fibonacci. One cannot use Elliott wave principle without Fibonacci retracement, Fibonacci extension. So if you are going to 24elliottwave.com, you must also go to dayprotrader.com. If you subscribe to 24 Elliott Wave YouTube channel, you must also subscribe to Day Pro Trader YouTube channel. It's all happening all over the place. So we will be watching a level of between the 50%, which is the orange line here, and the 61.8% Fibonacci retracement level of the whole trend or of the whole multi-wave. So as I explained to trader, with my experience, when I'm drawing a Fibonacci retracement on the yearly chart, I usually discount the shadow. I talked about it before, but one can draw both lines, so you put it at the top like this, see what is the 50% and the 61.8% level, be aware of it. You see, it's a little bit above the one that I have here, but personally, with my experience, my own trading style, all right, I put it at the closing price instead of the high there. Trader draw their Fibonacci retracement extension in a different way. All right, so I will be watching this zone here, between the 50% and the 61.8% Fibonacci retracement level of the whole multi-wave. So now that it's coming down, it can change direction at 38.2% level. That will be a shallow correction. Looking at this trend that was in place since 2000 for this stock, unless we are missing more data here, you have to take that also into consideration. With the information I have with TC 2000 here, the data that I have, that's all I can say right now, unless there are more information here that are missing, all right? So always think that way. So as it's coming down like this, we will say that very often after a multi-wave, buyers will place orders. This is what usually happens. Die-hard bullish trader will try to buy between the 50% and the 61.8% Fibonacci retracement level of the trend. So now that we were completely bearish here, talking about how to begin bulls and bear, Elliott wave principle trading like a pro, here we were bearish. Now if we come in near the zone between the $42 and $32 zone, we want to be ready to be a little bit bullish. So you will be mildly bearish as it's coming to the zone, and be ready if there is a bullish trading setup to take part into it. If that zone between the 42% and the 32, between the $42 and the $32 level has failed, if that zone between the 50% and 61% level, the price instead, after reaching that level, it bounces up. So it comes down to the zone and bounce up, and it's about to form a zigzag pattern. We will expect it to find a support near the 78% Fibonacci retracement level of the whole multi-wave. That's the line below here. I'll move my pink line there. That's the 78% Fibonacci retracement level right there. But if the fundamentals are not solid, it can come all the way to the beginning of the whole trend, forming what we call a cycle point. So we are a little bit bullish here in the zone, all right? But understand that sometimes it may be just temporarily bullish, which means price go bouncing up to reach the 50% of the first move down, all right, before coming down again to reach the 78% Fibonacci retracement level. So this is a bullish zone. This is also a bullish zone, provided that the fundamentals are okay. Oops, can you see what's happening here? All the spots are disappearing. Look at that. Oh, this one survived. Okay, so you see now? Boom, that was gone. Very interesting. Very interesting, very interesting. All right. So this is a bullish zone. We can be bullish in this zone. We can be bullish between the 50%, 51.8% level. But understand that sometimes traders will buy aggressively here. Those are Fibonacci traders, only to see the price bounce up a bit, only to come back below it. So always use a top-down trading method, control the risk, and trade it like a pro. So this is about how to begin bullish and bearish Elliott wave principle trading like a pro. The point where you should become a bullish, the point where you should become bearish. Okay. So you want to know those zones as you are counting waves, so you do not step on the foot of other traders. So what you are looking for signs. The sign that we are using, the volume bar, the surge into the volume. That's what I say to you. You'll be better to have another surge into the volume here, alerting that the bear are now back. All right? And which will also indicate to us that those who buy here are now coming out. They're not coming out very much. So watch the zone of 50% level. All right, be careful, because during the corrective phase, we want to see a bit of a volume, surge into the volume, and letting you know the fresh buyers are coming out. It's not looking like they are coming out very much right now. So look at the signs, the volume bar, okay? Look for the candlestick pattern, the shadows, all right? Watch the Fibonacci retracement zone between the 50% and 61.8% level. Look for the 78% level, all right? On the yearly chart, look for the shadow on top here, especially if you think that is the third Elliott wave. And if you want to see clearer, you drop it down to the monthly chart, and you see that what I'm saying is true. This is our third Elliott wave, followed by the fourth wave and the fifth wave. If you look carefully here, the zone where we want to become a bearish, there is a tiny, double retracement, a bit messy. 2, 3, boom. Here it is. A tiny 1, 2, 3. So price went down, went up a bit, a pull back, and then run up a bit. All right. 1, 2, 3, 1. This one is not subdivided into 3. Okay. But now it's coming down. That's 1. Because a higher degree multi-wave is ending, we will expect a proper correction. If the higher degree multi-wave is not ending, we will expect a correction that will be temporary. Now for this talk, talking about Tractor Supply Cooperative, EPIC TSCO, Tango Sierra Charlie Oscar, it lose to me. Also you see we draw the channel that was supporting the price before. That's the first price channel. Price maybe projected down, price bounced near the median line, retest the first channel, that it crashed down to the median line of the third channel. This is the third channel now. That's where we are now. Okay. In normal condition. All right. Here we are. We can apply now. I'm going to remove my Fibonacci. So you see, we are talking about Elliott wave, we are talking about Fibonacci, and I'm going, like this. I'm going to apply all the way to the tail of the A part of that a tiny flat correction, setting our target in a zone of 200% level. You see, this is the 200% Fibonacci extension level of the A part of that tiny flat correction. That's where the price is now. You see some traders took profit here. You see, bounce up. Those are Elliott wave smart traders. They bounce up here a bit before it's continuing to go up. So, is that the fourth manual wave of the C wave of the flat correction? Or are we expecting another move up? Or is that all? That's the question. If that's all, normally there should be another move down. Probably we're going to the zone of 238.2% Fibonacci extension level. All right, be careful. So, can continue to go down more into this level because that's the 50% and 61 point. You remember that zone? Between the 50% and 61.8% Fibonacci retracement of the whole multi-wave. Remember on the yearly chart, the $42 and the $32 zone. So that flat correction, instead of stopping at the 200% level, can come down all the way to the 261.8% 61.8%, even below that level, corresponding to the 50% and 61.8% Fibonacci retracement level of the bigger cycle. See, this is the zone here. All right. Okay. So if you have any question or suggestion, put in the comment section. In due course, I will be recording another video to answer your specific question. If you find this video truly useful, let us know by giving us the thumbs up. If you think that it's another blah blah blah, let us know by giving us the thumbs down. That will put us under pressure to improve our next recording. If you think that it's an essential tutorial, feel free to share it on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about how to begin bulls and bears, Elliott wheel, principal trading like a pro. Happy trading to you all and speak to you soon.